Hello and welcome to Moneycontrol. Well, the stock markets have been absolutely frantic over the past few days thanks to news flow coming in from the US, especially after the collapse of the Silicon Valley Bank. And yesterday, the inflation data that came in the US also was on expected lines, fairly elevated for the Fed to even think about pausing a rate hike. What's going to happen in the US markets? What do we expect on March 21, 22nd when the FOMC meeting is slotted to happen? How do we navigate Indian markets? We have a very special guest. I'm Mahalakshmi, and I have with me Adrian Mowat, emerging market equity strategist and an India veteran for many, many years. Thank you so much, Adrian, for joining me on this show today.
Hi there. Thank you for asking me.
Sure. First of all, over the weekend, Adrian, it almost felt like we are going to see an action replay of the 2008 financial crisis. It's not turned out that way, especially after the recovery we saw in the US markets today. Yesterday? What is your sense? Where do we go from here?
Yeah, so I think it's not correct to compare this to what happened during the global financial crisis. If you look specifically at Silicon Valley Bank, the assets that they were buying into were high quality assets. The issue was that they took on interest rate and duration risk. And as they saw a portfolio outflow, they were forced to sell those assets at a loss. But remember, those were very liquid assets. That allowed the authorities in the US to go in, take over the bank, and essentially make the depositors good without the need of using taxpayers' money. And I think they acted very quickly. They acted very quickly with Signature Bank. In the meantime, you see investors showing confidence in the broader banking system by the big increase in deposits at places like Bank of America, JP Morgan. So this is definitely not a subprime crisis, a Lehman type crisis, but it does bring to the fore that we've been looking so much at Fed fund target rates and not enough at quantitative tightening. Quantitative tightening reduces the deposit base within the US financial system and causes significant effective tightening of monetary conditions through that mechanism. And it shows up on the periphery, it shows up in the regional banks as causing this type of shocks. But at a corporate level, think about how corporations are going to be thinking today. You know, they've seen maybe themselves or some of their competitors perhaps not having access to deposits when the likes of Silicon Valley Bank or Signature Bank were seeing the deposit outflows. The banks that do have deposits that are still surviving, which is the whole banking system essentially, they are going to be concerned that they're paying sufficiently high rates for deposits to keep those deposits within their grasp. And in doing that, they're going to have to charge higher interest to their borrowers. And what I think the mistake that Powell has made is he hasn't talked enough about how QT is significantly tightening monetary conditions. And remember, we're doing that when we've had the fastest increase in interest rates that I've ever experienced. And I think if you go back and look at Fed fund target rate regime, the fastest that we've ever seen. So I think the US central bank's monetary conditions now are extremely tight, that they've probably overdone it in terms of their fight against inflation. And the narrative and the sort of market drivers for the balance of the year are going to be, you know, just how big an interest rate shock could we put into the system? And do we now have a growth rather than inflation problem to manage?
Sure. Fair enough. Right, like you rightly pointed out, Adrian, this is not a credit risk problem, but it is a duration risk problem. And you do have a large duration risk problem because we've seen a very sharp rise in interest rates. And this is, you know, this is also an important factor when you look at financials. So do you see, and you know, if you look at history of financials, there have been several instances of asset liability mismatches leading to a collapse of banks. How fragile would you say is the financial system in the US when you just look at this part of the risk, I agree that there is no credit risk problem this time around, but the problem is a different problem. And is it large enough to make the US financial system fragile at all?
So, over the weekend, my inbox filled with analysis of people looking at the published data, the available data, which looks at the potential for mark-to-market losses in the portfolio of securities that banks are owning. And when you look through that data, it provides you with a lot of comfort for the majority of the banking system. There were outliers, Silicon Valley Bank, Signature Bank, a few other regional banks. But the good news is the information is there, and we know the price of these securities. The problem when you go back to the Lehman crisis was we didn't know if there was any value in these esoteric derivatives that were particular tranches of a mortgage, and you just didn't have the underlying information. So I don't see this as the problem for markets. I think the problem for markets is going to be a growth one. And you talked about this not being a credit quality issue. Well, that's true in terms of the assets that a bank like Silicon Valley Bank was owning, but it may begin to be a credit quality issue if the US economy is now seeing this shock of these higher interest rates, the shock of slower growth, the shock of availability of credit. Then I think you at the micro level begin to see it being more of a credit quality issue. And I think if we were having discussions 6 months from now, our focus wouldn't be so much on the type of securities, the type of bonds that the banks own. It's going to be really more on how much are their credit costs rising as the impact of such a large rise in interest rates come through, both in terms of your funding costs, but also in terms of a decline in your top line, maybe a contraction in your operating profit margin.
Sure. Adrian, compared to, of course, this is not a comparable situation. I mean, you can't compare this to the 2008 crisis, which was of mammoth proportion. Also, the nature of problem was very different at that point in time. But considering the problem today, do you think the Fed is a lot more in control or can control any major collapse or fragility in the system by maneuvering what it can?
Yes, I think the Fed has acted rapidly. There's always a danger that, for the unforeseen things, we're not sure. But when I look at the information that we have available on the US banking system, the speed at which the regulators have acted, I think the Signature Bank situation is quite intriguing, how quickly they went in and took that over, that it suggests a regulator that's on the front foot rather than the back foot, which is certainly how we felt things were throughout much of 2007 and 2008.
Sure. Also, some people feel that this emergency lending mechanism that the Fed has talked about to provide liquidity to troubled banks which have duration risk, does that give is that something that gives a clear way for the Fed to actually keep raising rates without worrying about the fragility in the system?
Well, in that you're addressing the risk of having further bank runs, yes, it gives you a bit more flexibility. But I go back to my initial point. I think the central bank is making a mistake in underappreciating how significant the quantitative tightening impact is on the economy, how it's impacting the deposit pool in the US economy, and that it's putting up effective interest rates more than just simply the move in the Fed fund target rate. There was a paper published in November by the Atlanta Fed, which tried to estimate the interest rate equivalent move of the QT that's going on at the moment. Now, when you read that paper, the first thing I took out of it was they're really not sure. But if you wanted to take the headline conclusion, they're suggesting in a normal environment, it's about 25 basis points, about half the QT that they're doing. But in a stressed environment, that went up to nearly 100 basis points. And I go back to, I think Powell should have been talking a lot more about the QT plus the interest rates to emphasize how much the central bank has already done in the US to slow down growth, to control inflation. And now belatedly, we're starting to think about the impact of QT. So the mistakes here is not what the regulator's doing with regards to some of the distress in the regional banks. The mistake, in my view, is underestimating quantitative tightening.
Fair enough. So what do you expect in the FOMC meeting this time? First of all, what kind of, rate hike do you expect? And do you see a more divided FOMC this time?
I think that's one of the hardest questions of the year. It depends on which time of day you're asking me that question. I mean, it's absolutely fascinating how, if you look at what's implied in the futures market, the type of move that we've seen in 2-year rates in a very short period of time. If you had asked me a week ago, I would have been in the camp that a 50 basis point move was quite possible, so kind of a reacceleration. I think now there is a good chance that the Fed doesn't move rates because they begin to recognize the importance of quantitative tightening. The CPI print that we had last night, which was an acceleration in the rate of inflation, was actually quite well forecast. And there's enough leading indicators, in my view, that inflation will begin to moderate again, that I hope the Fed would not be too concerned about those data. We've got some big issues in US statistics at the moment. We were talking earlier offline about how the pandemic has made it difficult to know what a normal travel schedule is. Well, the US uses this technique of seasonally adjusting data. How do you seasonally adjust data where you just had 3 years of a pandemic, particularly in things like the labor market? And so I would hope that the Fed discounts some of this backward-looking data like the strong labor market data and the CPI and starts to think ahead about the shock that's coming through to the US economy from the very rapid rise in interest rates and now some of the stresses that we're seeing in the financial system.
Sure. Adrian, so far the Fed has been absolutely steadfast in sort of, repeating time and again that they will not relent till the target of 2% inflation is reached. Do you see the conversation moving in a different direction from there, that, maybe a 3% will become an acceptable level, or we are going to reconcile to a higher rate and there'll be a new narrative that, there is only so much of the inflation that is addressable through monetary policy and so on?
So I think they'll be very reluctant to do that because, once you move your inflation target, it's very difficult to have credibility around it. But if we look at this, going back a decade, for a long time, there was a lack of credibility around inflation targets because inflation was running so far below targets. So I think you can have a situation where they continue to articulate what the target is, but are willing to accept a rate that is above the target as long as the delta is moving in the right direction.
Sure. Adrian, you've already answered this question in part, but I'm going to, just for emphasis, I want to ask this question again. So far, the Fed's, priorities were number 1, inflation, number 2, growth. Now there is another dimension, which is, fragility of the financial system. Do you see any reprioritizing at all?
So I would suggest that the financial system fragility is really growth, right? So if you have stress in your financial system, it's going to have a material economic impact. And so I would argue, in the old days, the FOMC minutes used to be quite explicit about, was our focus on growth and employment? Was it on price stability, or was it more balanced? And you used to get a series you could draw off, which would show where the Fed was sitting in those priorities. So the priority from now for the past year has really been price stability. And I think now we're going to start to see a little bit more concern that, yes, the current economic data is strong, but the forward-looking economic data could slow quite rapidly. So we're moving slowly away from the prime focus being price stability. And let's not forget the recent history here. We have come out of the pandemic, but if you go back to the first quarter of 2022, we were still dealing with the Omicron outbreak, and you had Russia invasion of Ukraine. So in the first quarter of 2022, yes, we were beginning to come out of the pandemic, but there were quite a few concerns around growth, and it was very difficult for central banks to be focused on fighting inflation. It was in the second quarter of last year that you saw that dramatic shift in the central bank's focus, and that's when you started to see, meaningful changes in interest rate expectations and very painful changes in the value of bonds and equities. So that's 12 months ago. It is quite possible to get a pivot in a short period of time.
So what is your estimate of the terminal rate, and how long do you think we will stay there?
Yes, so we were sort of, you were pushing me for what the Fed was going to do in the March meeting. I would still probably go for 5.25. There was a risk it might have been higher at 5.5, but I think the probability of it moving much beyond 5.25. So I suppose if you put me on the spot, I'm saying balanced probability is 25 basis points this meeting, and maybe another 25. But by the time we've got to that next meeting, the evidence of the slowdown will be more pronounced, and the Fed will be moderating. And I think there'll be a lot more discussions about how much tightening has come through the quantitative tightening route.
Sure. Adrian, what does all this mean for Indian benchmark rates? Now, the differential between US rates and India rates is already very, very low. I mean, it's at, a 14, 15-year low right now. Yeah. Now, of course, if the Fed stops hiking rates, that's a different situation. But if there are even modest, 2, 3, 4 more hikes, where does India go from here? Do we have the luxury, or can we really afford to keep, not raising rates in tandem?
Well, so far, India has managed to avoid raising rates in tandem. And if you think about India on a global perspective, you've got still the fastest growing major economy. You do have inflation in India, but inflation is not significantly out with trend. And so India is a place that can run a modest current account deficit, and I think still attract equity capital, and that it's not an economy that's dependent on managing its savings deficit purely by just offering a higher level of interest rates. So I think there is a chance that Indian move in reference, or the RBI move in rates, will lag that of the Fed. And if we're only talking about another 50 basis points, then I don't think that is too big an issue.
So you would expect the differential to go down further? Will it not? Do you believe that that will not create any risks for the currency?
So I think the differential will go down further. It presents a vulnerability. So if there is a macroeconomic shock for India, its flexibility will be less, because the chance of the currency weakening will be higher. But if we assume that the current relatively robust economic growth in India continues, then this will be a place that will attract capital in a world where we're concerned about G7 growth.
Sure. Adrian, what is your expectation on India growth, number one? And from the market's perspective, this year has not really started off on a good note for India, especially because China is clawing back and a lot of money is moving not only to China, but also Korea, Taiwan, several other markets which seem to be better poised this year. So what's your take on India growth? And second, foreign relative outlook for Indian markets vis-a-vis other emerging markets?
So I would expect a moderation in growth, but the moderation predominantly driven by the external environment, just because of what we're seeing with G7 growth. With regards to the capital market, remember that India was a powerful outperformer in 2022, and you saw significant declines in the tech space, which hit Korea and Taiwan. And China was very out of favor, particularly with its zero COVID policy. So the story for very much, the January story was one of a rotation back into places like China and Korea and Taiwan doing better as a deeply discounted tech sector began to recover. Since then, the confidence in the China reopening trade has diminished, and we've seen quite a material sell-off in Chinese equities. So to some extent, that might help India relatively, but we continue to see Korea and Taiwan outperforming. I think the issue when we talk to, when I talk to friends, ex-colleagues, et cetera, who are global asset allocators, that for EM to work this year, they really need China to work. And that looked great in January and hasn't been since then. There is a hope that what happens is that the China macro data, and there was macro data out today that was reasonably encouraging, continues to improve throughout 2023. And that underpins Chinese equities, which are a large part of EM equities. And eventually that results in inflows into emerging market equity funds. But I think the chances of that happening near term are quite low, particularly as we've just been through a very significant risk aversion event, which was what we were discussing at the beginning of the interview with regards to the US banking system. Right. I'd love to, on an interview with an Indian business channel, say that international investors are really enamored by India and they're going to be committing more capital to India. I don't think that is the case at the moment. I think if EM was to see more flows, India would get its share. But really, to get EM flows moving, we've got to get this China trade working again.
Sure. Adrian, what is your take on the Indian IT sector? Because, for the past 1 year, obviously, there has been this talk about US recession, the huge BFSI contribution, all of which, the market has been guessing that there will be cut in IT spends. Obviously, these companies have, surprised every single quarter in the past few quarters. It's not really worked out. Do you see now valuations at a reasonable level for investors to start looking at it? Or do you think because there is no reason for these companies to really see some runaway share price growth, it's a call that you can put off for now?
I'm afraid it's the latter. I think you can put it off for now. So if we're looking at the broader tech space, we've seen quite strong year-to-date performance from the things like Meta, the holding company for Facebook, Tesla, et cetera. And, hopefully going to see some performance from the likes of Amazon. And the reason we're seeing this is to do with cost cutting. And there was another announcement of 10,000 layoffs within the Meta group. And so what investors are playing is deep value tech and cost cutting. And that's what seems to be rewarded in the market at the moment. And I think if the narrative is a reduction in the overall headcount for IT employees, then that's just not a good macro backdrop for the Indian IT companies. I think companies, if they're out with the IT space, but they are customers of IT companies, they are cost conscious. So to me, it looks like it's too early to be looking at this, but it is encouraging that valuations have come down. And I think it's really a question of the timing of the trade, but at the moment, I think it is too early. And I'm finding it more interesting to look at some of these US names, which are getting rewarded by share price increases in what's a pretty tough stock market.
Sure. So Two questions. One is, on a relative basis, where is India in your construct? How much overweight are you on India compared to, other markets? And second, if you were to peg the pecking order of sectors, how does it look?
Yes, so I'm afraid that, within the major markets, my preference would be Korea, Taiwan, and China over India at this point in time. I think China is a deep value trade with a catalyst in terms of the opening up. And so if you look at its PE versus history, the forecast earnings growth, it does look attractive. Korea and Taiwan, you've got some deep value tech. And in the case of Korea, you've got quite a good exposure to the EV supply chain. And so those markets, to me, look to have better opportunities at this point in time. And then, so, we've had a discussion so far in this call about financials. And it's quite tough to see Indian financials bucking the trend when there's a broader concern about global financials. We talked about the IT sector. And we did have, last year, there was some quite decent runs in some of the more commodity names, whether it's to do with aluminium, et cetera. I'm not entirely sure that those are going to be leading. So part of my reason, and again, I always feel a bit embarrassed when I'm talking to an Indian business program, not to come out with sort of strong recommendations in favor of India, but I'm struggling to think about what I want to own in India relative to what I can find in other markets at this point in time. But remember, that's kind of a good news story because India's been a decent outperformer over the last couple of years.
Oh, absolutely. But I'm curious to know, why are you not batting for Indian financials? Because, the usual narrative that the books are clean. And what you're seeing in the US, that's not typically the problem in India. I mean, your credit is, of course, at the margin, there might be some credit issues. But largely, the duration risk is also not as bad as it is in the US. So with respect to India financials, is there anything? I agree that the value gap that existed until last year has got bridged and valuations are no longer cheap. But is there anything else that particularly dissuades you from picking financials?
Yeah, so we've seen a sell-off in financials globally. And remember, the majority of the market cap is financials that have been managing their duration risk well, been managing their liabilities and their asset risk well. But those have got sold down. It doesn't matter whether you're looking at a JP Morgan, a Bank of America, a Morgan Stanley, a UBS, an HSBC. These things have all sold off, and I don't think they have specific problems. And so, Indian financials then look relatively expensive versus these large benchmark financials. So I'm not suggesting India has a specific fundamental issue. It's just on a relative basis, I might have better opportunities there. Fair
enough. Okay. You don't have to feel bad about not recommending Indian stocks to buy. You can always tell us where to sell. And tell me, if we were to assume that there is going to be an exodus of financial markets, if there is a shock, a macro shock, a global shock, where do you think the selling will really hit first?
So I would be conscious about what happened in the second quarter of last year, where, as these concerns in the financial system in the United States start to express themselves in people's concern about economic growth, we saw significant weakness in commodities. And so I would be nervous about commodity-related names. I would be nervous about energy as well. And I think that's where you would get an expression in the Indian market that would be a very quick read-through from what's happening in global markets.
Sure. And all the India-centric plays, and for example, the China +1 plays, those do you think will bear the brunt of selling, or those will be relatively insulated?
So just so I understand, when you say China plus one, you mean
Manufacturing companies, you know, a whole bunch of them, outsourcing companies, the Dixons
okay.
of the world, the specialty chemicals pack.
Yeah. So I think, look, we have a structural story, which is people are diversifying supply chains. And it's very important not to confuse cyclical discussions with structural
Yeah,
discussions. And so that to me is more of a tactical issue. Do I buy these things now, or do I wait for a better price? Because clearly there's a good growth story there. Where I'd be a little bit more nervous is at the commodity end. So if it is a commodity manufacturing, or it's actually a commodity, whether it's sort of chemical, cement, copper, etc., that's where I'd be a little bit more nervous. But I think that you mentioned a really important point here, and India is very well placed for this. It's got the scale, it's got the education base, the technical know-how to be a significant manufacturing hub and a place where the global supply chain can diversify too, as they try and reduce their China-specific risk. So I don't think that thing hasn't changed. It's maybe I'll get a better opportunity to buy into these things.
sure. Adrian, this is my last question. What is your take on the Adani pack? I mean, you saw so much, such a deep cut, and then last few days, it all bounced back. Now, what does it look like to you?
Yeah, so, boy, look, I think a lot of institutional investors have decided to sidestep Adani, and it hasn't been sitting in people's portfolios. That was primarily because the valuations looked high. I think we're still in a situation where the volatility around these stocks is so high that it's very difficult for a long-term investor to analyze how the share price is going to move. And for now, I would be very much in the camp of just staying on the sidelines and not having a strong view, and certainly not committing the portfolio to these companies.
Do you think the market has really put behind all these issues that we, questions about leverage, sustainability of growth plans, businesses? Have all those concerns been addressed?
No, and I think, you bring up this word leverage. So there's the Adani group where, people have, made observations about the level of leverage. But there's a broader issue here. We're coming from nearly 12 years of basically zero interest rates globally. Leverage has built up in the system around the world. It's built up in places that perhaps are not obvious to us at this point in time. But once this huge interest rate shock goes through the system, we are going to see further issues around leverage. And remember, leverage, think about this at sort of a basic level. The EBITDA of a company has to service the debt capital and the equity capital. And if you've gone from, let's say, paying 250 basis points over LIBOR, so you're paying under 3%, you're now paying probably 300 over LIBOR, so you're paying nearer 8%. The amount of your EBITDA that's servicing debt has gone up nearly threefold. There's less of that EBITDA that's available for growth. So I've got a company where I've got less of the cash flow coming to me as an equity investor. I've got less growth, so it's got lower value to me. And you begin to see this going through the system. And it's a pretty powerful negative. So we need to be conscious about leverage in all the investments we make, and also within the sort of the economic structure.
Sure. Thank you so much, Adrian. It was an absolute delight talking to you. Thank you.
Pleasure. Thank you.